All right, you guys. So we're going to get into kind of this new FMAX platform. As you know, coming up in a couple weeks, we're going to have this changeover where essentially outside of direct to VUL or variable annuity accounts, TFA 365 is going to be where kind of all business is going. And I will tell you, first off, anytime there's a big change like this, it's going to be bumpy. There's going to be a learning curve. It's going to come with a little bit of resistance, and I'm guilty of all those things. But I switched my mentality on this whole fidelity thing a few months ago from do I like this? Can I get on board with this? How much am I going to hate this? How much is this going to slow me down? To I think if I can get my arms around this, this is going to modernize my business in a way that I don't even fully understand. And boy, has that proven to be correct. And I'm going to show you guys some things that frankly, I think it impresses me. Like, I'm like, we have access to all of this at our fingertips. And I'm going to cover some of that with you today. Big picture, listen, there's no substitute for just jumping in the pool and figuring out how to swim, just immersing yourself into something. It's just step by step. I have figured out so many little tips and tricks, and no way could I cover all those things today. But maybe I'm 15, 20 accounts in now or whatever it is. And it's just like I've just learned all these things and it's just making it smoother. And a great example of that was last night. Joe and I did a client meeting. We brought in 650,000 of new assets to the team, which is absolutely incredible. Even Joe's 20% split on that, still like a six-figure account that he gets to get paid on and manage. But in all seriousness, and Joe, I think you can vouch for this. Um, I wouldn't have been able to do that meeting even 2 or 3 weeks ago as smoothly as I did last night because the client threw us kind of some weird curveballs, and it just led me to just quickly getting in and out of proposals, in and out of other dashboards, in and out of other things. And, this particular client has, what is it, like 8 or 9 separate accounts we're setting up, all these classifications of accounts he has.
7 right
And
now, yeah.
and honestly, and I'm going to say this facetiously, I almost impressed myself at how flawlessly I was able to get in and out of stuff. And you guys, it's just because I've kind of hit this critical mass of experience of getting in and navigating and learning shortcuts and learning. I popped right into research and showed them some returns. I went right back to proposal. I went right back to this proposal is different than that proposal. And there's so many takeaways you guys, we probably on relationship alone, because Joe's got a rock solid relationship with this client. I mean, this is an ultimate lesson of trust and credibility. Joe's bringing the trust. I'm bringing the credibility. Joe did a master class at bridging that trust and transferring that trust baton to me. I'm transferring the credibility baton back to Joe. I mean, it was a master class in, how our collaborative approach. And I think that's such a better, I mean, and maybe it's a sidebar. When we recruit somebody new, like so Alec is field training Tony Torrio right now, and rightfully so. Tony Torrio is 3 months into his career with us. Joe's been with us for a number of years. I don't consider it field training. I consider it a collaborative approach. This is how our team can best, represent what we do and serve clients. And we take a collaborative approach. And I think the more you work that into your vocabulary, what it allows you to do is it allows you to fly solo on every account and every case that you want to, but it also simultaneously allows you to so easily pivot to bringing somebody else in midstream, and it's just going to feel much more natural. And so, anyways, I just think that's a really powerful thing. But this case would have been harder had I not had the proposals that we now have. I would have had to do a lot more like talking through different things and just trust me on this and take my word for that. But I was able to show this client, as an example, they had, some accounts like IRA and retirement accounts that we should be very aggressive on, and some accounts we should be conservative on. And we might even, I don't have actually, that's all on Joe's dashboard, but I'm going to show you something similar on mine here, and we'll go through that. So as I'm sharing my screen here, Joe, anything you want to say about that while I'm pulling some stuff up here?
Nothing in particular, but yeah, that was what was impressive to me is just the ability to swap back and forth from different. Obviously, that comes with you. your extensive knowledge base about what we're talking about as well. But you know, um, yeah, the collaborative approach was definitely just a big thing because I'll be honest, if that meeting took place also 4 years ago, I'm probably sitting there playing a song in my head, not even paying attention to half the shit you're saying. But
Yeah.
now, it's a different time, and yeah, I mean, if just jumping in there was good, and then getting in here and doing all these proposals with you, and it was a lot to take in, but a good learning
Yeah,
experience.
and I'm not looking for any compliments. There's no ego involved in this, but I'm just trying to triple down on this idea of the more you get in and do it, this is where you pick up, you get smoother and smoother and smoother, and that's where confidence comes from. And I just love how we're managing money for people. I'm taking everything I used to love about Goldman, and I can do that here at a lower cost with a ton more sophistication. So let's just jump right into it. So I'm going to toggle back and forth on a couple of things here. But if I go back here and I go to home and let's see here, I'm going to get some things out of the way. Click proposals, and I'll just pick one right here. Oops. So one thing I love, and I don't want to spend a ton of time on proposals because we've covered that pretty extensively on past trainings, but I just want to show you guys, I want to give you guys a couple talking points because you guys are guys that are most using this platform and licensed to do so, where I'm just getting a ton of traction with people. So number one, this page is where I do all of my work right here. I'm staying right here. So as a quick lead up to this, there's been a few clients where I'll actually sit there and go through the risk tolerance questions with them. It's 6 questions. It takes, I don't know, 2.5 minutes, but it leads to some conversations. It's a fantastic way of getting some hot buttons on the table. It's a fantastic way of the client feeling like this is a workshop meeting. In fact, Joe heard me say that last night a few times. I'm like, hey, this meeting is kind of like a brainstorm session. It's a little bit of a workshop here. I really want my client meetings to feel less of a presentation and more of a, hey, we're collaborating together. I don't have a whiteboard in my office, but the parallel would be like, hey, we're on a whiteboard. We're mapping things out. We're kind of rolling our sleeves up together. That's where you build trust. That's where authenticity comes through. And so that's really important to communicate. And so that questionnaire is really valuable. It's just a way of involving your client in the process of creating an account. The second thing I'll tell you, just to give you guys some language that's been really effective, is I'm basically using the word fidelity institutional. And so I'm basically like, hey, let me tell you how I manage money or how we manage money. You've probably are very familiar with Fidelity Retail. I mean, and especially if they have a Fidelity 401k, which I mean, heck, 1 out of 3 people that walk in my office probably do. And I'm not putting retail down. I'm just saying Fidelity Retail is amazing. Like they're the biggest 401k provider in America. Their website's great. Their funds are fine, but you're kind of on your own picking your funds. And you can walk into a Fidelity shop, down the street from our office here, and it'll help you with your retail account. But what we use is Fidelity Institutional, and that allows me to really do some really sophisticated things for my clients. It allows me to custom build portfolios from a much bigger list of funds and strategies and really achieve much better outcomes than people are going to get on their own. And when I say that with some directness and confidence, I mean, you guys, I'm telling you, that's money in the bank. That's what people want to hear. They want to understand what we're doing. It's very clear and direct. So we go through in the risk tolerance. And so a couple of things that I've gotten a lot of mileage with. One is I talk about the risk score that we end up with. And I'll just talk clients through this. I'll just say, hey, I don't have any clients that are up at like 98 or 100. That's when you're, concentrated in, one sector of the market or something super aggressive. And we pretty much don't have just about anything below 50 because we need to outpace inflation. And so, my job with my clients is to help you understand, how much return are we going to get for the risk we can take. And I'm kind of talking to you like I'm talking to a client right now. I'm going to say things like, what I think the best portfolio is going to be for you is the most aggressive we can be that you're going to be able to sleep with at night. And some of those risk tolerance questionnaires will take you right through that. If your portfolio lost this much in a year, this much in 3 years, is really good at that. And so I'm going to spend a lot of time on kind of like dialing in this risk number. And and helping a client feel like we're really dialing in a custom portfolio for them. And then I'm going to talk about right here. I love this section, this pie chart right here. And it's just very clear stock. How much do we own stocks to bonds? That's what's driving a lot of this risk score. But then our concentration within here is. And so I tell all my clients, you guys have heard me say this, but one of my beliefs as an advisor is that we should overweight U.S. over international. Now, a proper portfolio should have some emerging markets and some international and some, potentially international bonds. But most portfolios, most target date funds, most retail funds, most mutual funds are just way too heavily weighted towards international, and it drags down returns. We're the center, we're the hub of the world's innovation, all the AI, all the tech, all the creation, the best universities in the world, everything the US is the hub of all that, and that's going to be a long-term theme. And I've never had somebody be like, yeah, I don't know if I agree with that. Like everybody's like, yeah, that makes sense. Okay. And then I said the second thing is I want to overweight growth over value. And I'll take people through what value is, what growth is, but value is kind of like your established companies that are still relevant, but McDonald's isn't adding new stores everywhere. It's pretty much established. And if they can grow sales by 3 to 5% a year, that's a successful year for McDonald's. And so, it's paying a dividend and it's a quality stock. And it's going to be there in a few years, but it's not going to outpace inflation like Google's going to, or Amazon, or Nvidia. And these are companies that are innovating and still expanding and still creating new products. And so we want to participate in the growth of those companies. And so you can see right here that, you're 30% in US growth and only 6% in value. And then core is basically just a generic word for a blend of both. And, when you can talk people, what I just did there in 4 minutes, I mean, that's a whole meeting, right? I mean, people are like, okay, that makes sense. I can get that. And people are going to want to follow people that they can understand. They're not talking over them. They're not trying to impress them with all these charts and graphs. So it's this, you're threading the needle of, you need to have enough sizzle or sophistication to demonstrate some credibility, and hey, there's some purpose behind what we're doing, but not too much where you're just over their head and they can't relate to you. They feel like they don't want to ask a dumb question in front of you. And so if they don't feel like they can ask you a question, who are they going to ask? Anybody other than you. And that's not going to lead to a great outcome, right? So I do a lot of work there, and I go right into fees here. And hang on, I gotta move your beautiful faces out of the way so I can see it. And I just talk about, and again, this is particular to this particular account, but how competitive are fees here. And I'll show you, the fee schedule that I use. But, when you use these Z shares with Fidelity, which I don't want to get too deep into building models today. We've covered that, and we can cover that some more. But I mean, your total platform cost is 21 basis points here. And then, my weighted fee is 1.21. I mean, so we're out the door at 1.42. And if I show you the details on that, you guys, I'm getting paid 1.25 on the first 150, which is a pay raise over Goldman. And then I'm paying 1.1. And so you have all the breakpoints in here. So I'm getting paid more on this than I would on Goldman, and the client's getting it at a cheaper overall cost. Plus, what you're going to see in a few minutes is they're going to get a completely different experience. And so, which, I mean, there's no way we could cover all this in the next hour, but I can't tell you how much I love this platform and what it's allowing us to do. And it's only going to get better from here. So what I want to jump to today is kind of, once you have an account set up and moving, what does servicing it look like? What is following it look like? Researching it look like? And so there's a couple things that are going to be hard for you guys to get because they were hard for me to get. And I'm still getting my arms around a few of these things. But one of them is the relationship between FMAX and Wealthscape. Okay, so you have two environments. You have FMAX, which is, it's on the front end. So FMAX is where you're going to do all of your research for all the strategies. It's where you're going to build your proposals and get the account ready to click paperwork. But once I go over here and I click get started and then generate paperwork, like once I click that button, I'm now pushing this into a Wealthscape environment. Wealthscape is where we're creating the account, open the account. They're going to have Wealthscape Investor where they can view their account. But what happens on the post sale, once the account's funded, is I can go back in and I can do some performance reporting, and all that's going to be on FMAX. So you're going to kind of simultaneously live in both accounts or both environments. So for instance, let me just show you. So this is a proposal. So now I'm going to go. So if you just log into Wellscape, click account, I'm just pulling up one of my clients here. I'll scroll it up just a little bit if I can, so I don't, well, you're going to see the client name. But anyways, the idea here would be Wellscape is going to show me all the raw holdings. And I can see kind of some performance, but really all it's going to be is current positions and unrealized gains and losses, and not really a complete picture. So if you can play with some of these drop downs. And again, there's some things that are beyond what I want to get into today, but I would just encourage you guys, as you start getting some accounts funded on here, is just spend a lot of time. Hey, what does this do? Where does this take me? Okay, and you're going to learn a lot of things. But what I've learned and what I want to show you guys today is I can get a lot more detail on the FMAX side of things. For instance, I built a proposal for this guy, and what you're going to see in a minute, because I'm going to show you on FMAX, is there's 4 different sleeves within his account. I built 4 different strategies / funds to build into this model. But this is going to blend all those together because this is just the raw holdings of his account. So I can't really tell what sleeve is doing what in terms of performance. So if I go back over here to InvestNet, and I'm going to go to Home and Clients, and then I'm going to click this client name here. So once you get into his account on FMAX, same dollar amount, 176,055. And I'm going to keep moving things around. 176,203. That's because there's a couple ETFs in here, or that's because there's stocks in this account that are trading per day. That's why. So FMAX is going to update at the end of every day. But minus intraday trading, this is going to be the exact same amount. But right down here, see these 3 dots right here? I'm going to give you the number. If you take one thing away from this training, I want it to be this. When you pull your clients up in FMAX, click on their account name, click these 3 dots, and then your very simplest path to performance reporting is this snapshot report. So if you just click that, this stuff blows me away, you guys. From here, I don't have to toggle anywhere. I don't have to get in and out of screens. All I'm going to do is I'm going to be able to, so if the client was sitting in front of me or I'm doing a Zoom review, I could do a couple of things here. One is I could just click this PDF button and create this like 60-page document with, I'm not going to do that for most people because they're not going to read all that. But this snapshot report is going to have all kinds of stuff in it, right? It's going to have time-weighted rate of return, benchmark return. But then from here, I can move through all these different things and see what I want to see. So for instance, if I want to see performance, I just click performance. And then from here, I can segment performance by what I want to see. If I want to see performance by period, so quarterly, monthly, you name it, I don't find a ton of value in this. What I find a ton of value is performance by manager, because now I can see this corresponds with the proposal I built for him. So, and this was one of my early accounts. I probably would do things a little bit differently, although this is working great. But at some point, I might true this up on, in my models, which we'll talk about if we have time today. But you can see that the Fidelity 500 index is up, I'm going to go over to start date. It's up 7.06% so all this started on June 10th. This large cap growth up 8.62. Now, listen, this is a short period of time. I wouldn't put any credence into this beating the S&P or trailing the S&P in a couple of months. But this is indicative of what I continue to expect. This large cap is going to beat the S&P over longer periods of time, but it's going to do it with more volatility, right? So really happy with that performance. I used an SMA called Zach's Focus Growth Strategy. And it's kicking butt, right? Its benchmark really is the same as the large cap growth, this Russell 1000 growth. And you can see the index is up 8.62. This is up 8.86. So, they're doing a good job with what they're doing. But what Zach's is doing is picking individual stocks. Also, all those individual stocks you saw in there, that's because I chose this SMA I only have this in one or two clients. But again, we can come back and spend more time on this. And then the model I chose was this BlackRock model. And it's doing fine. It's up 5.53. So it's, relative to a global allocation compared to just focused on growth or the US. I mean, it's going to trail a little bit, but it's doing a great job. So this really shows me, what each sleeve is doing. But again, this was before the Fidelity Z models were out, so I probably would use that now instead of the BlackRock. But I want to pause here. You guys following this, or any questions on what I've showed you so far? Obviously, as time goes on, we're going to have, 1 year, 3 year, 5 years, you're going to have a lot more data populate. I just love how I don't have to go in and create a report. I don't have to go in and set all the parameters like, okay, let's do it. Because like if any of you guys are using Awbridge, that's going to provide some data, but I got to go in there and say, okay, I want to see these accounts. I want to start at this point. I want to end at that point. I got to create a PDF. I mean, it's just much more of a manual, cumbersome process. This stuff is going to be automatically populated for your entire book of business, and then you can toggle through. I mean, there's some stuff I haven't even like done a whole lot here, but I mean, if you want to see every single holding and what it's done, every single stock this guy owns, is it up? Is it down? What has it done this quarter? I mean, the amount of data at your fingertips here is really incredible. And so, what I think stuff like this is going to allow you to do, especially as you get more and more familiar and comfortable with it, is it's going to allow you to demonstrate an incredible level of credibility and sophistication with clients in terms of the kind of money management that you can bring to the table at a really reasonable cost. If we go to performance by account, it's just going to, again, sum up the whole thing. So you can play with a lot of these things. You can go up to activity here. It's going to show you, this graph will get more meaningful over time. So this graph would be kind of more akin to what you're going to see on Goldman. And then, you can go in all kinds of different things here. But I think this is pretty incredible, you guys. And, I'm going to start using this more and more as I start doing reviews with clients, that I have funded on this account. So we're on this platform. Is that making sense? Any questions so far?
I don't have any questions. I just wanted to vocalize that, I'm following with what's going on. I do like see the value in this. I know 2 months ago, if we would have done this, I would have thought this was so out of my comfort zone. And, why can't we just have Goldman still? And I think I can clearly, as the advisor, see why this is a huge value add for the client, but then also for me and my business. So I really like this.
You guys, and I'm a few steps farther ahead than you guys on the same path of just getting in and playing with it. And and one thing I love about this platform is we have the right platform and we have the right people behind the scenes that are, tweaking this, adding to it, customizing it. And so, they're going to come out with this enhanced UMA, which I'm kind of piloting for them or beta testing for them right now. But it's going to expand, and I'm going to be able to get you guys on it in time, where essentially you're going to have a larger list of general securities. So if I go over here to research, and I mean, here's a perfect example. Like when I was with the client last night, I wasn't really in the performance stuff. We were kind of in his proposals, but then I wanted to show him because it was getting a little bit more technical, and he's a smart guy, and so I wanted to show him why I chose this Fidelity Z model over other models we could have shown. So I just popped right into research, clicked all solutions, and then I clicked this unified management right here. Now we were on Joe's platform, so his looks slightly different. But essentially I was able to come right here and then just show, okay, so let me tell you why I like these Z models more than the target allocation models. And one of the things that we came to was, I think we were looking at like this 85-15, although, let's see here. My listing is a little bit different. So for instance, yeah, because they're showing both Z models. Why is that? Here we go. All right, so you got to scroll down a little bit. So if you look at this Fidelity target allocation Z model, and you look at the 3-year return, it's made 14.88%. But if you look down here at this Fidelity Target Index Focused, 85/15, it's made 12.96. Because that's a significant difference. I mean, that's, let's call it 2% a year each of the last 3 years of outperformance. What's the difference between these two models? Well, if we pull up the index focused, and by the way, I would use this for some non-qualified accounts when I want to be really tax efficient. Because if I look at composition, it's basically just broadly owning some huge indexes, but it's not going to do hardly any turnover. So it's going to be very tax efficient. It's going to be super low cost. But remember, so you only have 3 basis points in expense ratio here, but you're not getting the platform fee credit here. So you're paying 30 basis points in a platform fee plus the 3. So you're paying 33 basis points. Okay. Not that I want to get too lost in the weeds. If I go back to the Z, why I like the Z models is a couple of things. So if I click this thing and go on composition, so now I'm at 22 basis points of expense ratio because they are owning some slightly more expensive indexes and funds in here. So when you add it all up, that's the weighted expense ratio. And B, I think they're adding a little bit of margin because they're managing this. So this is kind of a blend between active and passive. And so what's happening is like they have kind of some tolerances, like these are basically, I think broadly what they plan to be at long term is 60% domestic equity, 25% international equity. But they can manipulate. Okay, let's go a little more in growth, a little more in value, a little more in mid cap. There's some ranges they can maneuver, and that's part of what Fidelity is doing. But they're doing it at a super low cost. So because there's going to be some more rebalancing and some more, fund management, you're going to have a little bit bigger tax burden here because you're going to have a little bit of turnover. But if I'm picking up 2 percentage points more in performance, I mean, that's a huge value add right there. And so that's not a guarantee of outperformance. But let me tell you 2 things from a marketing standpoint that I think will help you guys. Number one, when I have a client that owns this portfolio, it looks like there's a lot more happening here. If a client has a portfolio with me and 60% of it is just sitting in the S&P 500, and I was a competitive advisor and I saw that, what do you think the first thing I'd say to that prospect would be? I'd be like, this guy's charging 1.5% to buy the S&P 500. Heck, you can do that for 4 basis points on Vanguard, and so I think this is a lot more defensible for a professionally advised account. And the bonus is you're actually delivering a higher return. The other thing I'll tell you, if you want to get really granular, is that the actual fee that the client is going to see coming out of their account is going to be cheaper here than on the other model, because they're not going to see this expense ratio on their actual fee, right? Because the expense ratio is taken out at the net asset value of these funds, okay? So for instance, when they see their actual fee, they're going to see let's just call your rep fee 1.1 for argument's sake. And then they're going to see the platform fee, which starts at 15 basis points. That's TFA's side of the fee. So it's a 30 basis point platform fee. TFA is charging 15 bips. Fidelity is charging 15 bips. That's kind of like $1 what you're starting with, okay? But they're crediting most of that 15 bips gets wiped away. So what the client's going to see is they're going to see 1.1, which is your fee. They're going to see 15 from TFA. So now we're at 1.25. And they're going to see probably like 3 or 4 bips on Fidelity side after the credit. So they're going to be at 1.28. That's what they're going to actually see. So if you do the math on $100,000 account, 1.28% of that on a monthly basis, that's their fee. If you do it on this account, they're going to see 1.1, plus they're going to see 15 and 15, they're going to see 1.4. I acknowledge that's probably a lot to follow, but do you guys understand just conceptually that the client's going to experience a cheaper fee if you use the C model versus the target model? And if you don't, I mean, now's a great time to voice your question.
Yeah, that was a little tricky to follow.
It's taken me a while to figure that out myself.
Don't worry, that
So let's
makes
do this.
two of us.
All right, let's do this.
I feel like too, Tyson, last night when we were talking like that, the 15 bips that you were talking about from like the platform fee actually went down to 14. Was that because did they make it a little cheaper because of the account values altogether as well?
Um, let's build a proposal here real quick. Start. So we're just going to do super aggressive here. I'm going to do a $100,000 account. Let's just say it's an IRA. We're going to create a custom strategy. I'm going to do, I'll do this enhanced, but I'll do it the same way you guys can do it. All right, add investment. So I can, now the enhanced lets me do 40% in funds, but right now you guys can do 20. So under securities, let's just do Fidelity 500 index. We'll go 10%, 2. And then let's go Fidelity large cap growth, 10. I'll do a drift to 2. And then I'm going to pivot over to products and models. And let's go 100. I'm going to do the non-Z first. So Fidelity target allocation 100 0. I can't do that one. All right, so we've got this thing. We've got our risk number up here at 93. I just love that, you guys. I mean, this is kind of like the beauty of Betterment. Like Betterment really did a great job of helping people see risk tolerance and stock to bonds and just make it super simple. And I think this is essentially the same thing. So we collect done. And we're going to save. And let's see here. Save and continue. One thing I love about this, by the way, is if you look down at the bottom, it says, what does it say? 30% complete. If all I do is, for some reason, it's not having rebalance annually. If I say, hey, let's rebalance this thing annually, save and continue, you're instantly at 70% complete. I love that progress. Okay. So here's what I'm trying to get at. And this is where, me doing this on the fly might not be exactly what I want to show you, but so intermediary fee is 1.1. So for today's purpose, I'm going to leave that the same. But what you can do is you can create your own fee schedule here. So I can do, this is my standard fee schedule I have, but on some accounts, especially if it's not a huge account, I don't do that schedule because it just comes in a little expensive. So it really depends on my client, what I'm doing, fee sensitivity of the client. That's a bit of a subjective conversation. Firm fee, this is TFA's fee at 15 bips. Okay. The program fee should be, I don't know if I chose the right model on a fly, but it should be 15 basis points. For some reason, this is giving you, this is showing you only 3 basis points. So I'm seeing a credit on this one as well, which I expected to see on the Z model. But your out the door cost is 1.29. Okay. You guys follow that so far?
You did not select the Z model.
I did not select a Z model, correct.
Okay.
So let's remember 1.29. Let me go back here and
Click edit model. No, it's account strategy.
And thanks, Alec. All right.
What I bring to the table.
Alec, you bring a lot to the table, buddy.
I eat it all.
So let's see what happens. See, because
Joe laughed.
this is what I used to use. I have a couple clients with this, but they've closed those out. So I don't. There's a lot of influx right here, but what I want to see is fidelity target allocation Z. And I'm going to guess that this is going to come in the same as what I just showed you. Yeah. So the Z model is charging you 3 bips. Okay. I know what I'm going to show you now. Instead of me parsing through fidelity, if I just type 100, it's going to come up with every 100% stock option we have. Let's say I use this BlackRock 100 to 0 or 100% stock. So here you go. Not a huge difference, but it's a difference. So you're paying 15 basis points here for Fidelity's platform fee. That's their FMAX fee. And then BlackRock's has like a 2 basis point kicker for their models. So that's why you get up to 1.42. So listen, you're still, if we try to replicate this similar same thing on Goldman Sachs, you'd be at 1.6, right? Your rep fee would be 1.1. So that's the same. But so this platform is still 20 basis points cheaper on a low end. But if you use the right fidelity model, we're down to 1.29. Was that where we were? I think 1.29.
Yeah.
So you're 30 basis points cheaper, you guys. I mean, you guys, that's right where the industry is. I mean, every LPL, Raymond James, Schwab Advisory, it's some combination of a 1% advisory fee and 25 to 30 basis points platform fees. And that's where the industry is, right? And so if you get any thinner from that, then you're just cutting your own comp. But obviously we can net that out. So does that make sense to you guys?
A quick question. So that's a apples to apples 1.1 that we're getting on Goldman accounts right now.
Apples at 1.1 is 1.1.
Okay. For some reason, I thought when dating, dating myself, when Trans One was like TWMS, you remember when it was called that? I, for some reason, thought it was like 99 basis points.
So so here's what you're thinking of. Your client's paying 1.1, but then TFA takes 10% of that. So this is the infamous double dip. That is still true here. So think of it this way. By the way, that's where originally that 1.1 was created instead of 1, was to basically get you right there at you're 99 bips.
Mm-hmm.
So yeah, I would love to get to a world where that second dip is removed, but that's a core part of their profitability. And I mean, guys, this is thin. I'm just telling you, 15 basis points is thin. So basically you could argue Transamerica is getting 25 bips if you count both of those. I mean, that is literally what they're getting is 25 pips. So it's not even an argument. But I mean, that's, I mean, they're doing a lot for that. I mean, this is going to be a core profit center for the whole company. So for all the staff and all the stuff, all the business review, all the home office, I mean, there's a lot going on there. So yeah, and so the parallel would be on annuities, they're taking 14%. That's why you see a 0.86% trail. Okay. So, they're a little more, when they launched advisory, I don't know, whenever that was, 2010 or whatever the year was. I mean, it's always been a 10% haircut.
Okay. No, I just wanted to understand what actually hits the code.
Yep. So on this setup, it would be 99 bips. So if I went in here and I did my custom fee schedule, so now if I'm at 1.25, 10% of that would be 12.5%. So I would have 112.5 hitting my code number.
Okay.
That's pretty sexy. I mean, hey, 10 basis points doesn't change your life, or 12 basis points on any one account, but you scale that over a $10 million book of business, and that's real money.
Mm-hmm. And so, yeah, I was going to ask you about that because you had a kind of a ladder chart in the that overview page you showed where it's a lot like Betterment, where it's a tiered fee.
8 points.
Yeah, the breakpoints.
Yeah,
So that one.
it's known as Joe's Crab Shack, just for reference.
All right. So if I show this, here you
Yes.
go. Here you go, Ryan. So this shows you the firm fee, which is TFA. You can see they're gonna really cut this. There's breakpoints on that too. I'm telling you guys, this is freaking competitive. Like I'm there to criticize things when they're bloated or inefficient or whatever, but I mean it's taken us years, and it's taken Transamerica leveraging a global relationship with Fidelity. Nobody is making money on this platform right now. I promise you. TFA is losing a ton on this right now because they're ramping it up. We just don't have enough assets on the platform to generate enough revenue to come close to hitting these numbers. And Fidelity is in the same boat. That's why there's a lot going on here, but one of many reasons why they're forcing everything on TFA 365, is it's an efficiency thing. We're getting off track here, but in fact, I think it's a good point to enter a recording right here. I want to just finish with one thought. Well, where'd that go? I gotta stop my share here.